Hey guys, Tex here. Thanks a lot for joining me for a video lesson on the futures market. So what I'd like to discuss with you today is some of the basics about the futures market, hopefully kind of open the doors to some of you who maybe have never considered trading the futures market. Maybe you felt a little intimidated by it because you've heard it's incredibly risky or it's where the big boys go and play with their money. And certainly while this is true, there's no reason to be intimidated by it. Just like any other instrument you trade in the market, it's very important that you understand what you're trading and the risk associated with it. But there's a lot of great benefits to trading futures, and I want to kind of address all of that with you today. Starting with the basics, what is the futures market? Essentially, it's just a marketplace where a producer of something, say for example, coffee beans, agrees to sell their product to a distributor for a set price over a predetermined period of time. And that period of time is simply the length of the futures contract. Now, every instrument in the market has a different length of the contracts that they offer, but us as traders, this whole process really doesn't concern us. All we care about is speculating on the price movement of the various instruments in the futures market. We're simply looking for short-term gains through either day trading or swing trading by speculating on that price movement. We actually provide liquidity for the futures market. So what are the risks associated with trading futures? To begin with, I'm just going to use the S&P E-mini futures as an example because it's probably the most liquid asset in the futures market and what most of us know. So let's say that we want to speculate on the price movement of the S&P 500 index. Well, a great way to do that is by trading the S&P E-mini futures. So we see that the futures closed at $29.83 this last Friday. Now let's say that we want to speculate that the price is going to go down. So what would we do? We would short, let's just use one contract as an example. We would short one contract at $29.83. If the price drops to $29.82, we make money. If it goes up to $29.84, we lose money. But how do we calculate how much we make or lose? So again, using the S&P E-mini futures, I'm going to look at this great spreadsheet that a good friend of mine, Anthony, created, and let's just go through this really quickly. So at the top here, here's our S&P E-mini, ticker symbol ES. Here is our contract months. We have HMU is the current contract period we're in, and we're about to roll over into the last contract of the calendar year, which would be Z. We look here, what is the size? Size, $50 times the index. So essentially, what is the price of the S&P 500 index right now? We take that and multiply it by $50. That gives us roughly about $150,000, just slightly under actually. So what that tells me is that if I buy or short one contract of the S&P E-mini futures, I'm effectively controlling about a $150,000 position. Now, of course, I don't have to have $150,000 in my account to control that position because of margin. So we look over here at margin, it says $6,930. Now, this varies from broker to broker. There are minimums set by the regulatory, but on average, it's about $6,900 in order to buy or short one contract of the S&P E-mini futures. So because of this margin offered by brokers, this allows us to leverage a much larger position than the actual capital we have in our account. So for that $6,900, I'm controlling a $150,000 position for just one contract. So that's obviously incredible leverage. And there's great, there's great benefits to that and certainly risk as well. Now, how much money do we actually make or lose on that one contract? So as I discussed, we shorted at $29.83. It drops to $29.82. In order to calculate our risk reward in the futures market, what we care about is the tick value. Every instrument in the futures market has a different tick value. The S&P E-mini futures tick value is 25 cents. Okay, so we see for every tick, we make or lose $12.50 per contract. So if there is 25 cents per tick, 4 ticks would equal 1 point, or we actually call it one handle. So if the price drops from $29.83 where we shorted to $29.82, that's a one handle move or a 4 tick move. So we just made $50 on the one contract. Obviously, if it goes to $29.84, we just lost $50. If it goes to $29.8275, right, it went one tick in our favor, we're up $12.50. Okay, so again, we are most concerned about the tick value when we talk about trading futures. That's how we calculate our risk reward. So obviously, it's incredibly leveraged. So, a one handle move or a 4-tick move in the S&P E-mini futures is nothing. It can make a 4-tick move in a split second. So you can be up $50 in no time at all, or down $50 in no time at all in just that one contract. So you start talking about taking a much bigger position size. Just to give you some perspective, let's say that we short 7 contracts of the S&P E-mini futures. We're now controlling over $1 million position. $1 million position with only $48,510 of our own money having to be put up front. Okay, that's pretty incredible. That's huge leverage. Now, obviously, I would never advise controlling a position of that size without adequate capital in your account or experience, to say the least. There are other options available to us. So say you don't really, have $7,000 to open a futures account with. So you're wondering, how could I possibly start trading the futures? Because I have to have $7,000 to at least buy or short one contract of ES. Well, one of those options available to you is by going with a broker like NinjaTrader. Now, I am not affiliate or anything of NinjaTrader. I just personally use them as a broker, so I can speak from experience. They offer what's called intraday margin. In other words, if you're only going to be day trading the futures, you can buy or short one contract of the S&P E-mini futures with only $500 margin required. So let's say you have $1,000 in your NinjaTrader account. You could easily buy or short one contract of the S&P E-mini, and you'd only be using $500 of your $1,000 to do so. Now, I wouldn't necessarily recommend doing that with such a small account, but just using that as an example to give you some perspective. It's incredible margin that they do offer, but it is only intraday margin. You have to have all your positions closed by the end of the day. If you want to hold something overnight, if you want to swing trade a position, then the margin and the maintenance requirement that you see here is basically what every broker is going to require. So for the most part, I only day trade the S&P E-mini, but so I don't have to worry so much about the higher margin and maintenance requirement here. So it's certainly a nice benefit to using a broker like NinjaTrader, but also the risk associated with that is that with that incredibly low margin, you can really get yourself in trouble if you don't have good common sense, quite frankly, in risk management. On the same token, if we were to short 7 contracts of the S&P E-mini using NinjaTrader as a broker, theoretically, we would be controlling over $1 million position with only $3,500 required in our account. Obviously, that would be pretty ridiculous to manage a position of that size if you only had $3,500 in your account. But again, I just use that as an example to give you some perspective. Now, there's another option available to you, which is a really great thing that has opened up the futures to the retail traders, and that is the micro contracts. A lot of the popular instruments in the futures market now do offer micro contracts, and they're far less leveraged than the E-mini contracts. So once again, using the S&P E-mini as an example, if you trade the micro contracts, they're 1/10 the leverage. So instead of a $150,000 position, you're actually only controlling a $15,000 position per contract in the micro. So that equates to a $5 gain or loss per handle move in the S&P futures. So if you buy or short one micro contract on the S&P, then you're actually only going to make or lose $5 per handle move. Now with NinjaTrader, the margin requirement for the micro contracts is $50. So you could theoretically open an account with very little money. I believe their minimum is $400. You could open an account with them with only $400, and you would be able to trade the micro contracts pretty easily. Now, I personally would recommend at least $1,000, but say you put $1,000 in your account, you could, really get started trading the micros for, take a few contracts. You're looking at $150 margin required in order to buy or short 3 of the S&P micro contracts, and you can still make some decent money on just a few contracts of the micro. So that's a great way to get involved trading the futures without having to take on nearly as much risk or leverage that's associated with the E-mini. Obviously, like with any instrument, I would really advise that you do back testing and paper trading. And the NinjaTrader platform does offer paper trading and back testing features that would allow you to develop a strategy that works before you ever risk real capital in the live market. That goes without saying, but obviously felt that I should mention that. So, like I said, that there's plenty of ways for you to get involved trading the futures without having to take on the kind of risk that you've probably, been intimidated by, or you've heard other people say how risky the futures market is. There's lots of options out there available to you. So with that said, just take a look at some of the instruments available. So obviously we've covered the indices. You've got the NASDAQ, the Dow Jones, the Russell. All of these things are great. Let's say that you really enjoy trading the SPY, for example, the ETF that tracks the S&P 500. The futures is a great way for you to get involved trading the market if that's something that you're interested in. Like with anything else, I would find, maybe one or two futures that interest you and focus on those. Get good at trading those. Don't try to trade everything, but I would like to just kind of walk through some of the options available to you when it comes to trading the futures. So let's say you're interested in currencies. Well, there are also currency futures. So you don't have to be a Forex trader to get involved with trading currencies because you can trade futures. So for example, here's the British pound, right? Let's say that you're familiar with the British pound currencies and that's something you're interested in trading. Well, here you go. You can trade the futures. And we would look at, what's the risk associated with that? We look at our tick value. The tick's very different, right? 0.0001 is one tick. So you're looking at a $6.25 per contract per tick move. Now we look at the point value, it's $62,500. Don't let that number scare you. Of course, that's a big number, but a one point or a one handle move in the British pound it's a huge move. It's just simply not going to make a move like that in one candle or even probably one day. Okay. So don't let the point value here scare you. Again, when we're trading futures, all we care about is the tick value. The tick value is how we assess our risk and reward on the trade. So just here's an example. There's lots of different currencies that you could trade. Let's say you have some experience with energy, right? You can trade crude oil. You can trade natural gas. You can trade ethanol. Just some examples here. And we look at what are the size, the tick value, and the margin requirements. I believe NinjaTrader margin requirements are anywhere from $500 to $1,000 for intraday margin requirements. It does vary from instrument to instrument. I'm pretty sure their margin requirement for crude is $1,000. So versus $3,400, as you see here, NinjaTrader's intraday margin requirement to trade crude is $1,000. And crude is another one of those that they do offer micro contracts. So, we see here for every penny move in crude, it's a gain or loss of $10 per contract. With the micro contracts, it's far less risk. So that's another option available to you if you wanted to trade crude, but you don't necessarily want to trade something quite as leveraged as this one. You could trade the micro version of it. There's also financials, U.S. Treasury bond futures, 10-year Treasury note, etc. Then you go to grains. You've got things like corn, soybean, oats. We've covered indices. Here's your meats, live cattle, feeder cattle, lean hogs. Metals, of course, everyone knows gold. You've got silver, copper, platinum. And then softs, you've got that covers things like cotton, orange juice, coffee, sugar, etc. So as you can see, there's plenty of different options available for you to trade in the futures market. I myself focus pretty much exclusively on trading the indices, but I will also trade things like crude and sometimes natural gas as well as gold. That's what I like to focus on, and that's what I do. That's what I recommend you do as well. Whatever interests you the most, be it currency, energies, indices, whatever, focus on that, get good at that, understand the instrument you're trading and the risk associated with it, and that's all you need to do. Finally, I'm just going to wrap up with a couple of perks, I would say, to those of us in the US when it comes to trading futures. The first one is actually a tax benefit. So those of you who trade stocks and options know that if you don't hold a position for at least a year, your capital gains are taxed at the short-term capital gains rate, which is a ridiculous 35%, okay? With futures, it's split 60-40. So 40% of your capital gains from trading futures is taxed at the short-term capital gains rate, which is 35%. The remaining 60% of your capital gains from futures trading is actually taxed at the long-term capital gains rate, which is much lower at 15%. So there's a huge tax benefit there for sure. Like I said, I wouldn't necessarily trade futures just for that, but it's certainly a perk. The other thing is there is no PDT rule, and this one is actually quite huge for those of us in the U.S. are well aware of the PDT rule, which requires us to maintain $25,000 in our account in order to effectively day trade stocks and options. With the futures market, because there's no PDT rule, we can actually open and fund a futures account with far less than $25,000 and not have to worry about being restricted on day trading. As I mentioned, I think NinjaTrader offers opening an account with as little as $400. So theoretically, you could open a futures account, put $400 in it, and you could start day trading and not have to worry about the PDT rule. So that about wraps everything up. There's obviously a lot more to trading the futures market. I just wanted to cover the basics with you guys, mostly the risk associated with it and just understanding the instrument that you're trading, and hopefully open the door to the possibilities out there if you've never considered it. Feel free to post in the comments below if you have any questions for me, you'd like me to elaborate on something. As always, guys, I really appreciate you watching. Do me a favor, hit that like button and subscribe to the channel for more content like this in the future, and I look forward to seeing you guys in the next video. Take care.